Traders, welcome back to another price action trading lesson where we're going to dive deeper into understanding the language of price action. We're going to talk about how price action moves in all price charts. We're going to start with the chart that is from September 21, around 2 years ago. And it's not that I specifically remember this from the top of my head. I'm not crazy like that. It's just that I had done a more detailed lesson from this particular day. Now, I want to use this lesson because it is very similar to the type of price action we got to trade today. And it perfectly depicts how price action works and how the patterns repeat over and over again. To understand what is the nature of price action, you have to grasp the concept that there are always channels being present on every single price chart, and they follow the trend line rule, which says after there's a break outside of the channel, let's say the close outside of this channel, and once prices attempt to create new extreme, you can expect correction or reversal. So we can see that after the downtrend played out with the breaking low, we have bullish trend that also played out with the break and a new extreme. Now, that's not the only thing that can help you to guide through the price action better, because what you can do, you can measure the moves, and a lot of times those moves in price action are measured, and you can use the measured move to help you predict the target. And you can see if you're going to measure the first leg, you're going to copy it and try to project where the target is going to be. You can see it gets you around this area. It overshot a little bit, but prices eventually continue working lower. Now, price action moves in pairs of twos. So this is why when you're looking for setup to take as a high probability, you're looking for the two-legged pullback at the key entry point, which is going to be most likely the trend line or the 21 bar exponential moving average, the supportive indicator only that you're using only as a supportive indicator, or some important key level. Now, the reason why I want to talk about this particular lesson, because as you can see, we had big leg down, two-legged pullback with the breaking new extreme, and notice what is happening. Once the uptrend is in play, you're looking for two-legged pullbacks to go long, and after the uptrend played out, you're looking for two-legged pullback to fail. And you can see, because counting from this high, you have a second entry long, and you're looking for the second entry long to fail because it's getting rejected by the EMA, the uptrend played out, and more importantly, this formation can help you predetermine where the trend line is going to be, because the market geometry is real. And a lot of times you will find your trend line of first two major swings, and you can see if you're going to connect first couple of swings right here, it's going to help you to find where the trend line is going to be. And at this point, the structure of the market is bearish downtrend, which means at this point you're counting for two-legged pullbacks to sell at key entry point. We have micro new low, first entry short, second entry short, micro new low, first entry short, second entry short, and counting from high, first entry long, second entry long that fell. It's all at the key entry point. After there's a break, you expect for prices to create new extreme. You can measure the first leg, see where it gets you. You can see the measured move was hit, prices corrected, but according to trend line rules, you expect for prices to create new extreme. This right here is the low of the day, where you always want to mark because you can expect correction. And after break, new extreme, you can see the bullish market has started and the trend has reversed. So we went through this a little bit quickly, but you're going to see how it resembles today's price action. Okay, so now we're looking the current day, May 10th, and this is the price action we got to trade today. And you're going to see a lot of similarities because this right here is the first major leg. And you can see there are always trends present on the chart. And at this point, we have a nicely fitting downtrend working lower, which means after you see close outside of this downtrend, what are you thinking about mainly? Where you're expecting for prices to retest the latest low inside of this downtrend. You're not expecting reversal despite the fact that you see prices breaking the channel. That's not how trend line rule works. You always expect for prices to retesting the new extreme, but you cannot just sell randomly. You want to see two-legged pullback, second entry short at the EMA. You can see it never formed. It's too far from EMA, so we cannot take a high probability setup. New low has been made, prices stagnated and reverse back into uptrend. So I'm going to do the same thing. I'm going to locate the channel. And you can see how nicely candles are fitting inside this channel. This channel helps me to stay on the right side of the market because I know as long as this channel is in play, I have to think bullish. Only after there's a break, micro new extreme, then I can consider thinking about possibly selling. But look at this uptrend. So steep, so strong, and a lot of times in price action, when you have a break new high and you haven't touched the EMA prior to break, there can be a chance for additional pushes higher. So you cannot really go long because you have a downtrend in play and you have a new extreme, so you have to pause looking to go long, but you cannot really sell because the move was quite strong. And notice this micro downtrend has a break and a new low. So even though you can see in hindsight we have a perfect new high, first entry long, second entry long failure, you cannot really take it because at the time when you're watching this leg has a small break, new extreme, and you already have a two-legged pullback, two broad legs down. And if you remember at the very beginning of today's lesson, the chart from September 21, you could see that the geometric formation at the top allowed us to spot a bigger downtrend, and almost the identical downtrend can be identified even today. But at that particular day, we saw that the failed second entry long formed as a part of one move, and it didn't have a break, new extreme, and such a distinct leg. So this is congestion. I recommend waiting here. Even after the fact, it looks a little bit better. But after prices are pushing lower, now you're expecting for prices to create new low for this downtrend. You may not have this big downtrend at the time. Let's say you're focusing only on this downtrend, okay? So you're not really having the wider downtrend just yet, even though you can possibly see that you have geometric formation that can be determined where the bigger chance is going to be. But you also have the major first leg. You can copy it, and this will give you around the area, the target where you expect for prices to go. So you can see that the price action repeats. There's a reason to all these moves, and you can measure the first major leg. You can go on a higher time frame, let's say 10,000 tick chart, to see the legs better, because right here this one big leg consists of many smaller trends, so it's kind of hard to see. But if you go on a 10,000 tick chart, you can clearly see one steep leg. So you can already expect stronger bearish momentum, but it's not it. Most importantly, this downtrend is new extreme. You're counting from the lows. You have a first entry short, pull back, and I have a second entry short. And notice what's important. The trend line rule applies even for the correction. So I have uptrend with the break, new extreme. This is good. This is indicating to me that the bullish momentum played out. I have two-legged pullback, second entry short at the key entry point while the downtrend is to get new extreme. Now you can see the EMA didn't really hold at first. You would like to see strong rejection, but this is still quite decent. I will mark it more aggressive because it is a little bit stacked. You can see EMA managing to get in on these bars. It is getting a little bit congested, but since you have a clear break and new extreme, you're at the EMA, and this downtrend is new low according to trendline rules. This is a okay setup to take a chance. When I was watching this live, I was looking for breakout pullback, but notice my lower high formed as bullish bar, so I have to pause. I cannot take, and didn't even trigger. The lower high triggered below this inside bar. This is where the lower high triggered, and you can see it acts as a breakout pullback. You have a congestion, prices broke lower, came back, tested it, EMA keeps holding, the breakout area keeps holding, and here notice what happened. This lower high triggered first lower, so there was a first entry short, then it reversed back up, so there was a pullback after you broke above this bar high, and it reversed all the way back down. So when I was watching this live, I treated it as a second entry short. It is kind of like a micro second entry short because it triggered first lower, then stopped the inside bar, and then reversed all the way back down. So there's a little micro second entry short, still part of the breakout pullback, and you can see how consistently the EMA keeps rejecting. This is a good sign that bears are still in the market. Bulls are getting trapped going long directly into the EMA, while this downtrend is expected to receive a new extreme according to trendline rules. So this is a great hypothesis setup. The signal bar is a reversal bar enough, and it generated quite a good runner. After we see prices pushing lower, at this point there is no denying that we have the wider downtrend in play. And you can see if you have the wider downtrend in play, I didn't even have it in play. At the time, I was just playing the reaction of the EMA in the short-term one. Had I had this earlier downtrend in play, this would have been even better setup for me to take. So I'm just going to copy it, put it at the bottom. We can see small little overshoot. This is where we have the low of the day, where we expect for prices to go. This is our measured move. Now we have new low, first entry short you cannot take, pullback, second entry short. I consider second entry short more aggressive because after overshoot, you generally like to wait for a lower high confirmation setup. So more aggressive, but you have two key entry points. Okay to take a chance, but then you have really good setup, lower high confirmation of the second entry short, of two key entry points, of the trend line, and of the exponential moving average. Great tier one single bar. It stopped you out, but it's okay. That's part of trading. You just brush it off on to the next one. You cannot really get frustrated. You cannot overcomplicate this. Now, as prices were breaking higher, I was looking for some two-legged pullback like this, and I was expecting for prices to create new extreme, but as you can see, it was not happening. Instead, we had quite a confirmed uptrend working higher. So I was thinking, okay, we have a two-legged pullback, so we may not get new extreme given the overshoot. So I redrew the uptrend. And once we confirmed it, I was looking for two-legged pullback to go long, but that didn't happen. And you can see, you cannot force your will on the market. You're just following the price action. The price action is unfolding in front of you, and it will tell you everything you need to know. So there was only first entry long. And once I see prices working lower like this, I'm giving up on this uptrend and it's starting to make sense. Okay, we're pushing so strongly to the downside. This means that this bigger channel is most likely going to get new extreme according to trendline rules. So it's easy for you to quickly adapt. There is no setup according to rules, and this shortened downtrend is confirmed, and you're looking for the same scenario that occurred around this particular area. So you can see new low, where I'm going to reset the count, counting for shorts, because it's the lowest low. I keep resetting the count at every single new low that is being made. So this is the lowest low of this move down. I have a first entry short, pullback, second entry short, but this is horrible second entry short. Notice how it formed. There's a big gap between the body and the EMA, and the signal bar has bullish body. It's part of this congestion. I don't want to take it. It needed to form closer to EMA with better bar, so you don't want to take it even though it's a second entry short. Then we had double trap, which now has a break, a new extreme of this uptrend, and it visually looks like the larger two-legged pullback, like the larger second entry short. But once again, it didn't take higher above this prior bar, and it pushed above EMA, which happens for double traps because they have to trap the early second entry short. So once again, if you took the short, not a bad thing. You can definitely take a chance here, but a little bit more aggressive. The safe thing here is to take the lower high confirmation setup, very similar to this. You can see you broke lower, all the bulls got trapped, and you have resistance preventing bulls go higher. The trendline rule dictates you expect new low for this downtrend and new low for the main one. So two downtrends are expected to get new extreme. A lower high is confirming the two-legged pullback and the double trap. Great tier 1 signal bar. You have plenty of room to get out before swing low. You're at the very top, very close to EMA. Great setup. I took this setup myself. Then you created micro new extreme, but you're not really looking to go long because this main downtrend may get new extreme. You don't know that after breaking new low, it's going to happen, but you're kind of expecting this. You definitely cannot go long in just middle of no man's land. So just wait. And you have new high, first entry long, second entry long failure. But since it already created micro new low, it's a little bit, I would have preferred taking the setup if it didn't create new low, because you can see the resistance coming into play again. You have two key entry points, the EMA and the resistance, but it's definitely a little bit more aggressive when I'm looking at this like this. But it pretty much paints the picture of how price action works if you follow the rules. And notice, big move to a new extreme was made. You're at the low of the day. You have a second entry short, but you cannot take second entry short because the main downtrend played out. And market is reversing all the way to the upside. And you can even draw slightly bigger channel, let's say like this, because even this bigger channel just has a break and a new extreme. So you cannot really stretch it more, draw it even wider because it will be too wide. And you can see clear bullish reversal, very strong and steep leg. Candles are fitting nicely. You're closing outside. You're expecting the two-legged pullback second entry long because this time you expect new high, but it never formed. And since this was so bullish, it looks like there's a bigger pattern in play because this momentum is very long and strong. So that's the first sign that there's probably a bigger pattern, and you're gonna get it confirmed by how well the EMA is holding. You have a latest highest high, first entry long, pullback, second entry long. I cannot take, not that the context is bad, but it is kind of tiny inside bar of this bar. It didn't even trigger below. So the context is good, but you need to have slightly better bar. And notice what happened shortly after. New low, first entry short, because this is the lowest low of this correction down. First entry short, pullback, second entry short failure. Great tier 1 signal bar of the EMA. You can see how the EMA is not letting bears break below. It keeps holding prices nicely. While according to rules, the uptrend needs to get new high, and this is a great high probability setup, the failed second entry short. Notice how strong the signal bar is off the key entry point, and the uptrend needs to get new extreme. And at this point, I can even look for possible bigger channel, but you don't want to be trading this late. Market is closing. You can get the idea of how price action works and what to look for. Your goal is mainly not trying to predict the price action, but rather follow it. And you want price action to confirm your analysis. You can see always look for these tight channels, always monitor the breaks and new extremes. And once you have a clear trend proven, you're just looking for high probability setup to form at the right key entry point. And this scenario is pretty much the repeat pattern of this. You had a losing trade, but it's a good trade to take. The correction was a little bit longer. It kind of surprised me, but after you have push below EMA like this, you're adapting and you're back into thinking bearish, and you cannot mistake this for anything else but a very strong reversal, because this was so sharp and it created such a big and long move. At this point, we have a nice felt second entry short counting of this low, and the EMA keeps holding. So look for these channels, look for the measured moves as they can help you. Mark the low of the day, the important key level. This is a lot of times where the reaction will happen, an important event in the market will happen, and you can see price action patterns repeat over and over again. So I'm going to wrap it up. I'm going to talk to you next time. Take care, everybody.